Hey everyone, this is the Investor's Guide to Joy podcast, and my name is Paul Graham. And today, for the tax savings CPA track, we're going to be talking to Stacy and going through several things to help you as a business owner or entrepreneur not only save on taxes, but understand them and your entity structure, as well as some of the best ways for you to go about on different levels of business growth. So if you are a six-figure earner, if you're a seven-figure earner, if you're an eight-figure earner, we go through each of these stages to ultimately help you understand what things you should be thinking about, what you should be doing, and how you should be doing it. We're also going to go through how to find the best CPA, especially at the end of the year here. It is a thing that probably no one's thinking about until at least February, but now is the time to ultimately have those interviews with CPAs to ultimately change, simply because it's beneficial to be prepared before tax season actually starts. The best tax professionals that I've talked to are right now sending engagement letters for the next year. So consider who you're going to hire and use for the 2025 year and the 2024 taxes. Also, if you are looking to offset your income in 2024, now is still an opportune time to invest in oil and gas to offset your high income and receive passive cash flow from that investment. More information will be linked in the show notes for you to inquire if it's of interest and benefit to you. Now, into the show. So today, Stacy and I are going to go through a number of different experiences that she's seen, with business owners for their business side, personal side. We'll get into kind of some tax specific things that she's uncovered for me and learn just all the tax things today. So Stacy, thanks for being on and sharing your insights here.
Yeah, thanks for having me.
Yeah, you bet. And so we, I guess, met and also know each other. We pretty much talk weekly in our Go Abundance Go Pod. So I'm very thankful that I have you in my corner for all goals in life, in addition to just like tax insights. For as I've been raising funds specifically for oil and gas, at least at the moment, we've really found that it's been for high income earners as well as like the business owners, like themselves as individuals and like 1099 in people, but not necessarily like the business itself invests in, maybe some like real estate syndication or oil and gas syndication or a debt fund or something like that. I have a feeling and a guess of like why that is, but would love to initially just, outline for business strategies. Like, does that make sense, or are people maybe scared of it, or like what makes sense for like the business and the taxes that they have?
I think for the businesses, the reason that they don't do a lot of investments within the company itself is liability reasons, because it's better to pull the funds out and have your investments outside of your entity. You have that corporate veil with an LLC or a corporation that protects your assets.
Yeah.
So you have investments, you don't necessarily want them within your entity because of that liability.
Sure.
And when it comes to oil and gas, you do get the deductions. There are benefits that it's not subject to the passive loss restrictions. And that is a benefit for C Corps to invest in passive investments, is because they are not limited. But because we don't have that, we don't have to worry about it. So that's where you have the individuals pulling the money out of the business and investing and offsetting their income on their personal side.
Yeah. Okay. So does that mean there's a difference in terms of how people might evaluate if they are like a C Corp or S Corp or LLC, or is that essentially kind of the rule of thumb of how people approach it?
I think with oil and gas, they could look at it based on their entity type, but the C Corps are the ones that get the benefit for passive investments because they're not restricted. They can offset all of their active income with the passive, and they don't have that. So I think when it comes to oil and gas, you're really just going to see the individuals investing.
Sure. Okay. Yeah. And again, I've not necessarily seen, companies invest in like multifamily or debt syndications or other commercial real estate type syndications as well. And it seems like that's the case. Before we go too far down this rabbit hole, because you shared some good points there, like tell us more of like what types of like companies and clients that you work with today, so we can also get a good sense of your expertise and, your knowledge as well.
I primarily work with business owners. They range from partnerships, S Corps, and C Corps. So depending on what their strategy is, their plans for exit, what they plan to do with the funds, all of that plays into what is the best entity structure for them. There are benefits that are available to each entity type. So a lot of people are very into S corps. It's not always the best strategy, depending on what you have. If you needed to take advantage of medical reimbursement plans as an owner, for example, it might be better to be a sole prop, a partnership, or a C corp. So, we had to look at the whole picture and determine what is the best entity structure. It's really not just based on income levels, which is one of the things that people tend to get stuck on with S corps.
Yeah, certainly. Yeah. And I would say, at least from, the number of businesses that I've, started and documented, if you will, they've been the LLCs, but it's like, oh, well, maybe I'll do this, maybe I'll do that. But it is income mindset, right? But there's a difference between being a, sole proprietor or partnership, but then also running a company like a business, in the sense of, how you're leveraging, how you're delegating, how you desire to operate, et cetera, as opposed to having individuals that are titled as a business. And so, for our conversation, really want to focus on people who have, call it a, 500,000 plus, or maybe like 2 million plus, like type business, because there's specific things that kind of come up at that level. As someone who's just starting out a business, like, they're not, from my experience, really going to have tax implications. Because if you're making, 20 to 100 grand a year as your business, like, you probably have more than expenses to kind of write off. And it's kind of like a simple, in and out sort of piece. But there's not like creative tax strategies that, could be done, because there's not enough, gunpowder being like income, as well as there's not enough opportunity being, like you said, in terms of like health savings plans or things around that medical nature. Oftentimes those individuals are, just getting that temporary, or they have some sort of their own sort of health insurance, but it's not directly, with the actual company. So with these, bigger, if you will, or more established, or however we might want to define it, type companies, what are you seeing as like the top sort of three things that companies should really, consider for, savings on taxes, or maybe even just like knowing about taxes, because then maybe they're not doing some of those things that they would then have to do some action again, just to sort of save?
So I would say, for the bigger companies, and I really look at profits as well as taxes.
Okay.
So when we're looking at larger companies, they're in growth mode. So we're looking at cash flow, buying more equipment, buying more vehicles for a fleet, opening up a new location. So the timing of that, how are those things deducted? Because we have depreciation on the fleet, on equipment, that it's subject to a restriction right now. 179 is at 60%.
Okay.
And so we're looking at that tax deduction piece, as well as the cash flow with those things, as well as staffing issues with growth. So how to get the best performance, so pay structures, and then looking at benefits for employees, the deductibility of those. You also have credits for things like starting up retirement plans, and for employees on auto withdrawals from their paychecks and putting in. So there are credits available for some of those things as well. So making sure that we're capturing all of those and doing the documentation to take advantage of them.
Okay. What help I guess me and maybe others understand in terms of like credits, like, is that like, hey, we're giving you $5? Like, help me understand more on like what sort of impact or return or benefit that's, getting. Are we talking about like $1? Are we talking about $1 million? Certainly depends on the amount of people and some complexities, but just curious of like what kind of splash would this make?
So for the retirement plan, it's the fees for setting up the account. So it really does. It depends on how many employees, how big is the plan, because what is that expense? So I did one recently where it was, I think there were about 25, 30 employees, and the startup costs, I think, were about $5,000.
Okay.
That's a $5,000 credit that if we didn't have all of our ducks in a row and make sure that we capture that, it could easily be missed. If you're just doing tax prep at the end of the year and you throw all your numbers to your CPA and you're not talking with them, that is often missed.
Yeah. It seems like that's like a different level of relationship access and like intertwinedness. Because I've seen this, with my personal life and business and investment life, where it's a difference of, hey, there's TurboTax, if you will, right? H&R Block-esque, right? Then there's, call it, the CPA, there's a CPA. And then, maybe there's a kind of CPA sort of strategist that's a little bit more, intertwined, and maybe there's more in-house. I'm not sure if there's others to kind of add, but definitely the, intertwined piece is big. How do you go about like having those conversations with, companies and what have you? As more of an investor, essentially, I found that it's been challenging to like connect with a CPA. In a lot of ways, it's just changing who my CPA is. But it's this idea of, having, to your point, frequent or sharing what you're doing or plan to do type things, as opposed to, oh, I did this thing, like, what's the bill? And kind of planning versus, kind of being retroactive. What are you seeing with companies and what they're doing?
So it is very common for me to hear that people can't get a hold of their tax preparer throughout the year. And that is the big piece, is being proactive and speaking with your tax preparer regularly throughout the year as things come up, as things change. So I work with my clients on a monthly or quarterly basis, typically, where we are reviewing their financials. So we're seeing changes, we're inquiring about them, we're asking them, what challenges are you having? What are your plans? What are you looking to do in the upcoming months? So we're getting that data pulled out of them with those conversations. And I think the biggest issue that we're seeing with tax preparers is they charge so little for tax prep, and they're doing thousands of returns, and they just do not have the time to talk to all of those 1,000 clients throughout the year. It's just impossible. So that's where you're seeing the more concierge, proactive CPA firms pop up and offer that higher level service that a lot of business owners are really asking for.
Yeah. When would you maybe recommend, I mean, I'm thinking like revenue type level, or maybe it's more profitability, that a business kind of transitions from a, hey, kind of do my taxes to, be, more proactive, like we're mentioning?
I'd say definitely at the 1 million, but it really depends, because I have had clients at the 400,000 and 500,000 level that they were really serious about growth, and we were able to guide them through that growth. And, like I have a roofer who was at 500,000 when they came in. Now today, a year and a half later, they're at 10 million. So, just being able to be there and give them the guidance. We're doing a little bit of fractional CFO work with them, as well as the tax strategy. So it really is dependent upon, I think, the business owner's intent, their ambitions, and where they're headed. If you're a $500,000 business and you're sort of the status quo, you're maintaining, you're not looking to grow, and you're pretty much seeing the same profits year after year, then you can probably create a strategy one time and stick with it, because you're not going to see any growth or change in your situation.
Okay.
So I'm not sure if that answers your question. But
yeah, no, I mean, that's a good thought to think that, it's not just like the income level, it's more of the, like it's like psychographics than necessarily demographics. So it's like, hey, we're looking to grow and expand. We're here right now. Like, what should we think about and, proactively plan for? Because then you also have a destination, and then you can like back into it. One thing I found with business owners is that it's sometimes like a, hey, well, I didn't know I should tell you that or share that, or, what have you. And so, you either grow or die, but even just the idea of like how you want to grow or where you can grow is, important to share. Beyond, growth, I would assume, sharing in terms of like contraction is another, intertwinedness to really have someone who's, proactive, so that we can kind of catch things, as they fall. And, for different strategies for businesses, what is maybe something that's like a myth or like a misnomer or something like that, you've seen people come through and have some sort of perspective, opinion, experience sort of on?
I'm trying to think of the best one to give right now. I mean, definitely the S Corp is the best.
Okay.
People are very afraid of C Corps because of the double taxation, but there are benefits, especially if you're looking to grow a business to sell it in the near future. There are qualified stock benefits to a C Corp, where if you qualify, you have $10 million of stock sale that is tax-free. So I guess in total, entity type is often not what people think. the ideal entity structure for them isn't necessarily what they think it is.
Yeah. Yeah. And I would echo that. It's kind of like when you start it, oh, it's going to be great. I'm going to be, have a $10 million stock sale and, you can barely get out of the six figures type piece. So, I mean, is that something that you could like transfer into different like ownership types? I guess I've not really.
Yeah. Yeah. So you can change your entity types, make different elections at different points. So, and that's the benefit of working with somebody proactively is you can watch that and make those changes when they make sense, as opposed to being stuck in the wrong entity type during a period that maybe you should not be that type of entity.
Sure. Okay. Yeah, makes sense. And definitely in a lot of ways, I would think takes, pressure and concern off from people from then the like personal side. So, hey, I'm a business owner. I'm doing, these types of, numbers of high six or even, 7, 8 figure type numbers. What sort of strategies and conversations are you having more on like the personal side to help these business owners or even kind of executives or others that are like, high in these companies?
So it's harder because depending on your income type, right, that really can limit your deduction. So if you're a W-2 high income earner, what deductions do you really have available? So of course we want to maximize any deductions that you have. So if you're charitable, that might be doubling up in your charity efforts every other year to take advantage of an itemized situation. If you aren't regularly giving enough to hit you over that threshold to itemize, but it could be taking advantage of your stocks if you have losses that you can harvest from some of your brokerage accounts. So it depends on what kind of investments you have.
Okay.
Being invested in other businesses, but you have to be somewhat active, or something like oil and gas where you have the benefit of being able to treat it as sort of an active and offset your active income. A lot of people go to real estate not realizing that the passive losses from real estate can't offset your income after a certain point if you're not a real estate professional. And then the real estate professional rules also get messed up a lot. I have people that'll come in and say, oh, I got my license so I can be a professional. I'm like, well, but you're a W-2 that works here and that's nothing to do with real estate. So like a license in itself won't qualify. You have to hit the hours and all the other rules that the IRS gives.
Yeah. Can you share what that limit is for active income when it doesn't, I guess, equate?
So you have to have over 50% of your hours in real estate. So if you have a W-2 job, you'd have to work more in real estate than you do at your W-2 job, and then 750 hours.
Yeah. Okay. And isn't there something along the lines of like, if you make more than like 150 and you're not a real estate professional, you can't take like passive losses or something like that?
Yeah, so you can be active and you can take up to 25,000 of losses if you're under the income threshold. But then if you're over that income threshold, then you're capped.
Okay. And 150 is that level?
That sounds right.
Okay.
Off the top of my head, sorry. I think that's
we can confirm it, consult your CPA or email Stacy. So one thing I found, with the individual, and certainly for some of these companies, if they're at some of these, levels, they're probably making, 150. But just to dive into this, what is that like 150 essentially like only active income, or is that like all income? Certainly for me, I have my short-term rentals, long-term rental, and then, have had W-2. Those W-2s have been close or sort of over the 150. So that completely gets me out. But like, as I have not had, a W-2, if I have, call it my 2 short-term rentals, they're grossing over 100 grand. Like, do those get counted, or is it based on reporting? Cause it's not that's like gross income for the property, but that's not like dollars in my pocket type income. So I want to kind of separate that for the people in real estate.
it is looking at your total income.
Okay.
So not just one source.
Okay. But so is that like dollars in pocket, or is that gross revenue of the properties?
Well, it's a taxable income.
Okay.
So it's the income that gets reported. So for your business or real estate, it would be the profits, taxable profits.
Taxable profits. Okay. Yeah. Good deal. I want to switch a little bit and go into these thing I've learned a lot about, these trusts. So there's a bunch of like companies that are, essentially saying, hey, there's a special kind of trust that allows you to not have capital gains and, hides income taxation and a number of different things. I shared this and you knew and found information on this. So I was curious if you could just share more what your experience has been with these like kind of trusts, and then also, what you've found on them as well.
So the IRS issued a memorandum, which I had forwarded to you.
Yeah.
What had happened was some attorneys misread the instructions of the trusts. And so they were marketing these trusts that were exempt from taxation on the capital gains. So they say, oh, put your properties in this trust and they don't have any tax. Well, they were reading about distributable income. And so what happens is a trust pays taxes on a 1041, which is the equivalent of a 1040, which is your personal income tax. And so if the money stays in the trust, it gets taxed on that 1041 form. If you distribute the income, then it goes to the beneficiary. So the income always follows where the money goes. So if you had a trust and you got distributed the income, the trust would issue you a K-1 and you'd pick that up and tax it on your personal return. So they read it and they said, oh, it's not included in that distributable net income, so it doesn't go to you and get taxed. Well, they stopped reading and they didn't see that it does get taxed on the 1041 itself. So trusts are not exempt from taxes.
Okay. Yeah. And that's, seems to be a, hard line in the sand, for someone who has maybe gone down this path of doing a trust. Like, do they have options, or what options do they, have? Because they potentially put, real estate in the trust. I mean, can you just take it out of the trust and kind of like unwind it, or?
So I would say we'd have to get the attorney involved to see, and what is the timing on that? And was a gift tax return done to properly get it into the trust? So if it's the same year, I would say, yeah, just retitle it, pull it back out. No harm, no foul. It's all the same year. But if it's different years and a gift tax return was done, now we're probably looking at having to do another one to gift it back to yourself and get it out.
Okay. Yeah. Yeah. I mean, definitely doing things in the same year is absolutely imperative for taxes. And so, my parents for the longest time used TurboTax, and their gift to each other for Valentine's Day was, or my mom's ask for Valentine's Day was that my dad kind of completed taxes and did it on TurboTax. Since then, I brought them over to, the CPAs that I've worked with. And so that certainly changed things. The idea of completing things within the same year, again, is what taxes are. And so I found that most business owners, yes, industry professionals, high income earners, like as well, business owners themselves are then going to be, focused on completing in the same year because they probably have an accountant or a bookkeeper that they're, kind of paying or things like that. But to that company that doesn't have that dedicated resource or kind of does it themselves or things like that, I would love for you to just share, like, especially like Q4. Like, my viewpoint is that you should have everything outlined for Q4, and then you're kind of like, oh, for the rest of the year, it's just going to kind of do this, right? That way you can have these proactive conversations with your CPA, like you're mentioning. But one, is Q4 like the start of Q4, like the time to have everything kind of, ready to go and kind of finalize for the rest of the year? And the other question is just like, what sort of opportunities are, missed by people not completing and understanding things like in the same year?
So yes, Q4, typically I would meet with my clients mid-year at a minimum, July usually, and see what has the first 6 months been like, what do we plan? And then it is a November check-in at year end to see, do we need to pivot? Did we hit where we thought? Are we on track? Or has something changed, good or bad? And what do we need to do to pivot so that we can do that before December 31st? Because you don't want to wait up until, and I get those calls on December 31st. Hey, I'm here trying to buy a truck. Does this qualify? What deduction does this get me? How much should I spend? So we want to avoid those phone calls. And, I do get those calls too of clients that I have that are grandfathered in that aren't proactive, even though I try. And they'll say, oh, okay, great. I had all that profit. I have that tax. What can I do now? Not a whole lot. So before year end, we have the opportunity to look at, is there anything that we want to prepay? Is there, going into January, February? Because I'm not a proponent for spending money just for the sake of spending money. If you do not need a new truck, we're not going to go buy a $70,000 truck every year. That's just insane. That doesn't make cash flow sense.
Yeah.
So like, what do we need? And timing wise, what should we put our money into? And, paying bonuses. And I've had people pay large balances on their credit card. Like, well, that's not deductible. Like, so just knowing where to put your money, what makes sense, and what's going to get you the result that you're actually planning on getting as well.
Yeah, certainly. That in some ways has kind of been a joke on some calls or just interactions with people. For me, again, for high income earners or maybe the business owners on their personal side is, yeah, like instead of just like buying the G-Wagon, like invest in oil and gas. It has higher depreciation than, real estate, especially with Section 179 and bonus depreciation decreasing. And then, from some of these returns, maybe you also go get it, right? There's enough, to go get a lease or something, right? But just the idea of constantly buying a highly depreciated asset to drive around with, yeah, it doesn't make sense to me. Maybe it's because I love my 4Runner so much and I put, so many decals on that thing and I lifted it and put a winch that, I'm not willing to, buy some of these 6,000 plus vehicles. But even from like an income standpoint of the business, it doesn't necessarily equate. Certainly if you're in like construction-esque, like maybe there is a justification for it. But yeah, to your point, every year just seems a little bit silly. One thing I was thinking about as you were mentioning some of this is I'd love to go through this idea that came to mind of like, what sort of best practices would you give to like the 6, 7, and 8 figure, earner? So whether they're a business owner, a 1099 employee, or just like high income type person, let's start with that, 6-figure, type person. I'm thinking that they, should be, buying some sort of, real estate, right? They can then, get some sort of deductions with a couple things. And then, type of maximize 401k, Roth IRA, type stuff. But what, validate those things or, poke holes in them, or what other things would like 6-figure earner should be like really, focused on?
So it depends, because real estate isn't necessarily going to help you with your tax situation. If it's passive and you're trying to offset, the depreciation against your active income. So it really comes down to, what are your goals? Does it make sense if you find a property that is going to actually cash flow and show loss? Is it going to be a property that's going to appreciate? That makes sense. It's a long-term game with real estate. The retirements, you're kicking the can down the road if you're investing in retirement accounts that give you a deduction today, because you're going to pay tax on them later. So trying to put in and, convert directly to a Roth, so you don't get the deduction today, but it's growing tax-free. So it's not just about saving money in taxes today, but over your lifetime, let's have you pay the least amount in taxes overall. And so I'd say with the 6-figure business owners, what makes the most sense? If you have cash, let's try to look at what will increase your profitability, what's going to increase the value of the business so that you can sell it later, what's going to increase your cash flow so that you have more money coming in from that business. So we're always going to look at that investment as an opportunity. What can we do there to make that better? And does that make sense? And then also, diversification. So looking at oil and gas, looking at other partnerships, other investment opportunities, just overall brokerage statements, what makes sense with the extra cash that we have as well. And then tax advantaged brokerage accounts, things like that we could look at.
Yeah, absolutely. So then for that 6-figure earner investing in real estate, like what types of real estate do give, tax advantages?
Well, in that situation, I'd want to look at, do we have maybe a spouse that isn't working that we could push into real estate professional status? Potentially. I have several of those situations where we were able to have the spouse working on the real estate and making it completely active in that case. If you have a commercial property that you own for your business, that's active. And then there's shifting we can do between the entities to make that make sense.
Okay.
but primarily real estate, it tends to default to a passive situation.
Sure. Yeah. And I mean, there's certainly the active potential for like short-term rentals, but again, having those hours and aspects are imperative. For
Yeah.
that seven-figure, individual, definitely going to be, more things that could kind of come up. So what specific things should they kind of think about and know from, and great point, not just for saving taxes today, but like taxes like overall and like profitability overall, and also not just having expenses for the sake of expenses. So what would that kind of seven-figure earner really need to like think about and consider, or just like ask questions to their CPA?
I think it really comes down to what are their goals, what are their interests. And I think it's really having that conversation with your CPA so that you can build the best plan for you. But you do want to look at everything that you are spending. Are you getting a benefit? So looking at, are you deducting all of your, medical, your dependent care, all the things that have benefit plans that could potentially be in place in your business and be deductible? Are you taking advantage of those? Is there anything that you're spending money on that can be transitioned to business use somehow so that you're not missing out on deductions? And then when you're looking at investments, what are your interests? And then how is that actually going to play out through your tax situation? And is it going to give you the benefit that you think? Because I have tons of people, and I keep going back to real estate, but I have tons of people that get into real estate thinking that they're doing it for the tax benefits. And then they don't get those tax benefits. And then they're bummed because it's a lot more work than they really wanted. And so it doesn't really align with their goals, and they wind up selling and getting out of it and then finding something that does more align with the lifestyle that they want.
Sure.
So,
What are some examples of that lifestyle that you find people invest in after they maybe, again, to your point, the real estate isn't getting them what they want or how they like it with lifestyle?
definitely more into other businesses. So, passively investing in friends' businesses, a lot of brokerage accounts, syndications, a lot of syndications because it's completely passive. And they're like, okay, so I'm diversified, I'm in real estate, which is great for diversification, but without any of the toilets, trash, and tenants, which
sure.
nice.
Yeah, you bet. And it's like the true passive, not the long-term tenant type passive, and short-term rentals are not passive at freaking all. I get, messages all the time, but it's outsourced, but then, that causes like tax implications. For then someone who's like eight-figure-esque, beyond them buying a private jet. And they maybe shouldn't at that level, and that should be maybe more a company thing, but jokes aside, like what does that sort of like strategy and things that they should, look at, think about, ask, and understand?
When they're getting to that level, they're building their team and they're looking a lot more at benefits. Again, the entity structure may need a change at that point, because once you hit a certain bracket, then the double taxation isn't as much of a big deal because you can change how you can pull money out. So instead of taxing all the profits, for example, if you had a C Corp and you're at a higher income level, you can then lend money from the corporation to do different things. So there's different ways to pull money out of different entity structures. So the more you make, the more some of those more creative strategies make sense, as well as like income shifting and potentially having management companies or payroll entities and shifting income through different types of entities as well can come into play.
Yeah, sure. So it's still getting kind of the same outcome, but it's just more of like who owns what and how that's kind of facilitated.
Yeah, and you're looking at like liability protection too. So you want to pull different pieces out and put it in different entities for liability protections as well as the tax savings.
I mean, is that something that should be considered for a 6 or 7-figure earner in terms of liability protection? And I guess let me change the word should. Is that a need for a 6 or 7-figure, type individual?
You definitely want to look at making sure that you have your separate entity and that you're keeping everything segregated from your personal life. And then as well as property, typically, no matter what level you're at, if you own a building, say you're a manufacturer and you have a building, you want that building owned in a separate LLC than your manufacturing business. And I can't speak too much to the liability. You would definitely want to consult with your attorney, but typically I advise people to speak with their attorney about that and to look into making sure that those are separate.
Yeah, certainly. Okay. That's great to know, especially towards, the end of the year here, people are thinking of, well, hopefully they're thinking of taxes, but regardless, how would you recommend people find like the best CPA for them? Again, we'll mainly focus on, business owners or, people that are, have these high income type roles within companies. But what sort of ways have you found that people, find you or that other people find, CPAs?
So definitely through referrals. So asking other business owners who they use and then interviewing that CPA to find out what is their experience level. You want to make sure, in my opinion, that they have worked for other firms before they have opened their own firm, or that you're going to be working with staff that has been trained by somebody who has a lot of experience, because there's a difference between what you learn at school versus what you experience and learn in the industry. So I'd say ideally somebody with some public accounting experience at a firm would be great. And then also, what designations do they have? Are they a CPA? Are they an EA? Are they a certified tax coach? What kind of training are they doing to keep them up to date on different strategies and tax laws? Just making sure that they have an answer to those questions. And then, maybe asking them a couple questions that you can corroborate, and make sure you like and agree with their answers, because there are a lot of different, tax law isn't necessarily black and white. There's a lot of gray. There's a lot of interpretation that has to happen. And we lean on IRS memorandums and other entities even to sort of go through and read and sort of say, okay, this is what we think that they mean by this, but there's a lot that's left to interpretation. So you want to work with somebody that you enjoy working with and that you sort of agree on how to interpret things. Are you a little more risk adverse, or do you like to walk the line? So you just want somebody that's ethically similar to you.
Okay. And what, I think you mentioned EA of sorts. Like, what does that stand for?
So that's an enrolled agent, and they take a short exam on just taxation versus a CPA takes 4 exams, and it covers accounting. You have risk, so the auditing, looking at controls. So, that's when you go in and you look at what kind of controls are in place to prevent fraud and theft in the business. So CPAs are just more widely versed in all sorts of areas versus an EA is just tax.
Is that something that anyone can kind of take, or is that more like a dedicated study career professional only for the EA?
You could definitely study for the exam and take the exam.
Okay.
It doesn't have the same requirement. CPA, you're required to have the 5 years, 2 years experience under somebody. So it's a lot more rigorous to get through and get the CPA exam.
Yeah, certainly. We talked a little bit about how to, kind of these different stages of, CPAs and the services kind of they offer and things like that. One thing I've also found is fees. So I've seen a lot of CPAs have like different levels of, hey, it's like, $1,000 to file some stuff, or it's, $2,000 just as an individual, or it's like a, $2,000 an entity. And it's like, well, I have all my properties in an entity. So like, are we really going to charge like 10K out the door? Like, what are we talking? So what have you, found of like how individuals should go about understanding like the best, CPA and, what they charge, and ensure kind of what the value they're getting is in alignment? There's this idea of like solution selling, where it's like, hey, well, you pay me 10 grand, I save you 50. It's like, well, like, it also then becomes this like, well, are you giving me the best, value and benefit? Because this is a very like specialized and time consuming thing. Like, I'm not going to have 2 CPAs just to see like who's going to do a better job, right? Like, this isn't a painting quote that I get for my house. So, how does that sort of conversation or questions kind of come into be, and where do you kind of fall align with that?
It is really hard because it isn't the same as getting a painting quote, right? You have 2 or 3 companies come in and you say, hey, I need this wall painted, give me a quote. It's apples to apples. But when you're looking at different CPAs, it's not necessarily apples to apples. So I do believe very much in you get what you pay for. So you have people that are out there doing business returns for $400. That no way, like there's no world that should happen, because when you do a business return, you have to tie out the balance sheet I feel like you should be reviewing the balance sheet, even if it's not required to be in the return itself. And that goes down to making sure that your income and your expenses are correct. Because if your cash account doesn't balance or it's negative, and we just say, oh, well, it's negative, I don't want to look at it, I'm going to ignore it, which is what happens with some preparers, because they just take the numbers that you give them and they plop it into the forms. That's the difference between a tax preparer and a tax strategist. So you don't want somebody to do that. You want them to say, hey, this doesn't look right. Let's get it fixed so that we're filing an accurate, complete return.
Sure.
And so I would say, hey, are you going to ask for support and ask questions on my balances? Look at the reconciliations, look at the bank statement, make sure it all matches. And then also keeping the equity and basis schedules. Somebody's got to do that. And a lot of times if the person preparing the business isn't the same as the personal, they'll point their fingers at each other and then nobody's doing it.
Sure.
So, I will track the basis for the business owners. So when you think about all that compliance and all the questions that have to be asked to mark the right boxes, it just really should be more expensive than $400. So if you're getting a really low quote in the market, I would ask sort of why. And if you're getting a really high one, ask, what does that entail? And, if you get an IRS notice, are you going to look at it? And is that going to cost me an additional fee? Because the services aren't apples to apples. So you do have to really ask, what am I getting for this fee? And then what is going to be extra if I need it?
How, I guess, do you operate? The IRS piece is an interesting thing to think about. So, if a client gets, a letter or something by the IRS, like what does that look like for yourself, or maybe if you have different packages?
Yeah. So for the tax preparation, we do automatically require support and we tie out all the balances, we keep the basis. And if there is an IRS notice received on that tax year, then we will review it and respond. So, if it's an IRS error and we have everything, we'll send it and say, please correct your records and work with them until it's resolved. If it's something that the client, like, oh yeah, there was this thing and I forgot to give it to you and there is an error, we can assess and make sure, okay, yeah, the IRS is right. We'll just tell them, yeah, you're right. Here's what we owe you, our bad.
Sure.
So that's definitely all a piece. And then we also have monthly packages that include proactive meetings for tax strategy, CFO level. It all depends on what the company needs.
Sure. Okay. That's great. And, we talked about this maybe a week or two ago, but right now you're sending out like confirmation engagement letters of, hey, like, we'll see you next year, or, hey, like, we've kind of gone another direction. That has been something that, CPA or well, at least one did and one did not. So I wanted you to share, maybe not necessarily the thought process behind it, because to me, in a lot of ways, it's kind of black and white, but it's just more of, when should people be thinking about evaluating tax professionals and getting it kind of locked down and secured? And if they are maybe, uncertain about if their current professional is going to be them next year, certainly emailing them, but what sort of timeline is that?
So we are sending out our tax season letter now, and engagement letters will be going out in a week. The thought behind it is we want to know who's going to be working with us, because when it comes time to collect documents and potentially do extensions, we need the time to potentially calculate their balance due with those extensions. So we're not going to prepare extensions for anybody who doesn't sign and pay with us. And we don't want to be in a situation where at the last minute we're trying to chase down, and are you, or do you find somebody else? And do we need to calculate a balance due with this extension and prepare an extension? So we just don't like to be last minute. It's stressful. It creates errors. Things fall between the cracks. So we like to operate proactively. So we want to know who's a client. Then we can, make sure all their stuff is in on time and there's no, oh, you need to get to the post office today and get this payment in. We just don't want that for our clients. And then as far as finding a new CPA, now is the time, because it really doesn't take that much. A lot of people are afraid to switch because they're like, oh, it's going to take so much time and I'm going to have to explain everything. Well, we can learn a lot and understand a lot from your forms. So it's really not a ton of work for you as a taxpayer to switch, but we do need time to update our records, get you into the system, have everything rolled over. So now is the ideal time, because we just don't have time to onboard during tax season.
Yeah, absolutely. No, that's great. And that makes complete sense. Yeah, thank you for going through this. Super helpful for me and definitely business owners in a lot of different aspects. What would you say in this kind of guided joy of how people, or I guess what you would put in terms of like a mindset, mantra, quote, something that you would kind of write in to this guide?
Knowledge is power.
Okay.
It's easy to stick your head in the sand and say, I don't like math. I don't like the numbers. It stresses me out. Maybe your profits aren't where you want them to be, but it's not going to change if you do that. Like
Mhm.
the knowledge is power, and knowing gets you on a path to fixing it. So just suck it up and meet with your CPA and be in the know and help, let them guide you on what to do next and
Sure.
give you those baby steps
Yeah.
so that it's not so overwhelming and scary.
Yeah, it's making me think of like making a t-shirt. I'm really into graphic tees. So making a t-shirt that's like, call your CPA. People are like, oh man, I should do that. Stacy, thanks for being on. I always enjoy talking to you and going through this. And I'll put in the show notes where people can connect with you more. So thanks for your insights.
Yeah, thank you.
Hey, one last thing before you go. I wanted to share my mission while on this earth, and it's to help educate investors about different opportunities, share mindset tips on how to change our perspective, and different things to really experience more joy in our lives. If this resonates with you at all and you enjoyed this episode, please share it with friends and others to help grow the community around the Investor's Guide to Joy. Leaving a 5-star review also helps grow the show and get connected to more people and share our experiences along the way. Thanks so much for joining, and can't wait for you to listen to the next episode.